Good afternoon, everybody. My name is Matthew Burns. I am a trader in Chicago. I've been trading about 10 years. I work at a proprietary trading firm, a prop firm you've probably heard. Trading has undergone a big change in Chicago the past 2-3 years especially, and there's very, very few firms that even hire human traders anymore. But nonetheless, that has nothing to do with what we're going over today. And you probably heard, as if you read a lot of the websites out there, kind of the death of the individual trader, and I don't think that's the case. I just think the environment is changing very rapidly and very quickly, and with what I'm going to go over today, market profile, I believe will help you to regain an edge as an individual trader. I'm going to go over the material, and I'll take some questions at the end. So if you could just hang on and write your questions down, and I'll be happy to answer them. Okay, practical and actionable uses of market profile. Here's a disclaimer, as you've probably seen in any sort of futures publication whatsoever. With regards to trading futures, it is a risky endeavor, but no more risky than any other types of trading if done correctly. The stark reality of the situation now is that you will not make a living by exclusively trading the S&P E-mini contract on a daily basis. And the reason I say that is because the industry has pitched the S&P E-mini as a contract that's easily understood because it refers to the S&P 500, and a tradable product because it is very liquid that you can trade on an intraday basis, day in and day out, and make a living doing that. And yes, there is times where you could trade the S&P E-mini intraday and for extended periods of time, months at a time, and do very well. Right now, in the past couple of years, it's been extremely difficult for a lot of reasons I'll explain later. But if you don't take anything from this seminar, I want you to take the concept that there is a whole plethora of futures products out there that are just as easy and accessible as the S&P is, trade better, have better trade facilitations, aren't completely dominated by computer algorithms and high-frequency trading groups, and that I think you'll find more rewarding and less stressful to trade than the S&P is. But nonetheless, we'll talk about the S&P today because everyone watches the S&P, as you should, and I'll use it for an example today. But if you don't take anything from this seminar, your trading needs to be based now on a global macro perspective, which is looking at across all markets, whether it's energy, metals, agricultures, currencies, what have you, because there is a pool of money that moves around the world, whether it's a risk-on or risk-off perspective, and there are opportunities. There just isn't the same opportunity in the S&P every day as there used to be. So broaden your perspective and back your charts out, and that's what we'll start from. What's an individual trader to do? Well, the odds are stacked against us like never before. The only way to succeed in this environment is to completely reprogram your brain. And I know this because I was a floor trader 10 years ago, and so I know a lot of floor traders, and you guys see these guys on TV all the time. Don't worry about what they have to say, because floor traders don't trade anything like we trade on the computer screen. We need to use what's in front of us and acquire an edge, and there is an edge in the market that the institutions don't have, and I believe that market profile can be used, if used appropriately, to actually trade with an edge. It's going to take a lot of patience, a lot of sitting on your hands, but it can definitely be done. There isn't a holy grail in the market. Market profile, I think, is the best way to adjust to the new way that prices have been distributing over the past couple of years. And if anyone tries to sell you something, whether it's a chart or a way to make 1 point or 2 points every day in the S&P, it's not true. It doesn't exist. I work with guys that make several $1 million a year, and I've worked with guys that lose lots of money every year. And none of them use any of these sorts of gimmicks that you see every day being pitched to you online. Everything you've learned about trading is based on a trading environment that simply does not exist. And here's an example of a chart that, if I have someone send me a chart sometimes to see what they're looking at, this is usually what it looks like. The techniques being taught by, I'd say, almost all trading education firms and by brokerage firms, what have you, are based on pit trading techniques and old technical analysis, which is looking at a chart techniques, which I think, because of their mass adoption, have been negated. And I don't know anybody who trades a candlestick chart and looks for, dojis or hanging man or head and shoulders and this sorts of thing and makes any money. Yes, these patterns can work sometimes, but over a large enough sample size, you're going to find yourself spinning your wheels and giving money back, which is, I'm sure a lot of you have experience with. I do as well. I've tried every single chart pattern out there, trading method out there, and the only one I've found with any sort of an edge is market profile. And now market profile, like I said, isn't a system. It's a way of organizing data. So like I said, nearly all trading methods are based off pit trading techniques, which have been invalidated due to their mass adoption, and structural changes in the distribution of prices. And by the distribution of the prices, I mean how prices move back and forth during the day to find value. And I know QE and the Fed have skewed everything probably much more so than anyone's ever seen before, definitely much more so than I've ever seen before. But there will come a time, and I think it'll be soon, where the market loosens up and there will be much more opportunity in all sorts of markets. So the dome, which I call the depth of market, or I'm not sure what all you guys call it, it's the platform that you enter your orders in. The dome was created to help pit traders make the adjustment from the pit to the screen. And so they see these prices flickering in front of you all the time, and you think something's going on, and it's not. And so rule one into reprogramming your brain is to take down your order entry platform. Minimize it on your screen, because it should only be used to enter a trade, put your stop in, and you need to leave it alone. Because the algorithms and high-frequency computers are designed to cause confusion on the dome, because it knows everybody looks at these, and it really, really hinders your trading. I see a head and shoulders pattern. Well, this is, like I said, what the industry has a interest in promoting these sorts of techniques as a way to get people to trade, and a way for people to visualize what's easily seen on a chart as a way to trade and to make money. And TD Ameritrade, Schwab, I'm just listing a couple, they have a free pattern spotting platform that can pick out any sort of pattern, a head and shoulders, a cup and saucer, a pennant, all these kind of things. If they can pick those out for free, and they'll give that to their retail clients for free, you can imagine what these enormous computers at firms like Getco and JP Morgan and Citadel, you can imagine what they see before you do. So if you assume that 95% of traders fail, which that's the industry number, and the number is probably higher than that, you have to assume that they're all looking at the same chart, which pretty much everybody is. And so if you can teach yourself to look at something different, whether it's a longer period chart, 60 minutes, 120 minutes, daily, and market profile, you can already take about 80% of those people out of the equation. So, like I said, a lot of the mass adoption of these strategies has caused these patterns to be negated. You're almost better to trade the inverse of these patterns. And if you pay attention tomorrow when you're watching the market, you can probably see how most of these patterns are invalidated some way or another. And like I said, you're better off trading the inverse. Market profile allows you to enter positions where you actually have the odds slightly in your favor. So if we can envision ourselves being a blackjack player, the times that you double down is when you slightly have a better edge than the house. And so the times that we're going to place trades is when we have a slight edge. And you can get an edge if you're patient and you wait for the right times. Now this is what a market profile looks like, and you say, okay, what's this do for me? Well, I'm going to cover what the basis of a market profile is, but this is the S&P, this is crude oil. It doesn't matter. They all distribute basically the same. This is in October, and it doesn't matter if it's October or tomorrow or yesterday. These profiles end up all looking the same, and you can go back to the 20s if you want, and they still end up looking the same. Prices distribute in market profile in what is originally thought to be kind of a bell curve. And as you can see, these all kind of form some sort of a bell curve situation, even though sometimes they're skewed out to the upside or the downside, or they're perfectly balanced like this. And we'll cover that later. Well, here's a quick history for you. Market profile was developed in the 80s at the Board of Trade, where I work, as a way for organizing data. And the book that Peter Steidelmeyer drew up was called Mind Over Markets. Many of you may have heard of it. It's an old book. That's considered the Bible of market profile trading. The methodology that Steidelmeyer came up with was very useful at the time, and that was a completely different market. That was when markets had a set open, a set close. The prices were all being determined by about 100 guys standing around the floor at the Board of Trade and the customer orders that came into that pit. And so a lot of the tactics of market profile are useful in that environment, and I think harmful to you in this environment, as we've been trading in the past 2-3 years and the way that we will continue to trade. Okay, well, what is a profile? A profile is basically a 30-minute bar chart. And if you don't have market profile software, you can sort of see a profile if you look at a bar chart of a 30-minute periods. But each letter indicates it's called a TPO, or time price opportunity, or whatever you want. It doesn't really matter what they're called. This is the S&P. This is November, I guess. So a letter will print at every price that trades during that 30-minute period. Regardless how much trades, the volume there doesn't make any difference. It'll just, whatever price trades during that 30-minute period, it'll plot along this vertical scale. And then the C period starts. This would be from 9:30 to 10 Eastern. This is 10 to 10:30, 10:30 to 11. And then a profile is developed by kind of smashing these things together and forming a distribution, they're called. So this is a standard bell curve you might have seen in regards to anything. The bottom line is that 70% of trading occurs within the middle of this curve, or the fat part of the curve, and 2% trades way out here on the edges. And if we want to look at this and apply it to trading, we don't want to be involved in here with all the random HFT guys chopping themselves back and forth. We want to be on the edges and the edges only. And as you can see, we'd only be involved with 2% of the crowd here. And so we're just by participating on the very edges of a distribution, we're already upping our odds. We want to be in the 5% that make it, and the 5% that trade on the edges, and that's not very many people. So I've basically boiled it down to this, because I've struggled, just like any of you have, trading through different periods, using different patterns, different systems, different ways of looking at the data. I've basically come down to this. Markets are in two states. They're either unbalanced or balanced. And that's true on a 5-minute chart, on a daily chart, on a monthly chart, on a 1-minute chart. The market's either balancing or it's unbalanced. So for instance, the S&P on a longer term basis is on an unbalanced up market right now. As much as everyone wants it to come down, that's just what it's doing. I can't argue with the data in front of me. Do I think it should be here? No, but I don't think anybody does. But that's neither here nor there, and that's not going to help us make any money. So we want to trade at the short-term extremes of unbalanced markets. Balanced markets offer negative edge and should be avoided. And a balanced market is looks like a bell curve. There's people in the middle, 70 to 80% of people chopping themselves back and forth, and those are the markets that we want to avoid. I say it like this: if I was going to be a stock trader, I wouldn't sit there and trade GE stock all day long, every day, and expect to make money. I'd pick whatever stock or met my liquidity conditions, and I'd look for a market that was moving out of a larger balance or was in an unbalanced move, like Netflix or whatever. I mean, you can name any of these stocks that are going nuts right now. We only want to participate when the deck is stacked in our favor. So we want to basically act like card counters. And part of market profile, the market profile class, is going to teach you when the deck is stacked with a bunch of face cards and we can actually make some money.